Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter, funds editor on the Investors Chronicle, and today I'm very pleased to be joined by Carson Block, founder of Muddy Waters Research and a well-known short seller. Carson, thanks for joining me today. How are you doing?
I'm doing well. Thanks for having me, Dave.
So I thought, first of all, it'd be interesting to chat to you about, I suppose, the state of kind of short selling and perhaps it's a different field, but also, activism. Sometimes people might group those together. We had the interesting developments in January where Hindenburg Research, quite a well-known name, kind of abruptly shut up shop. And you were sort of commenting on, I suppose, some of the kind of stresses and strains that come onto short sellers now. So what do you think of the general kind of state of the short selling space? Is it getting harder to kind of operate in that manner? What are the kind of important developments you've seen in recent times?
Sure. So I think it's important to first differentiate activist short selling, where typically we're looking for companies where managements have misrepresented information to investors, from general short selling, which general short selling is usually betting against melting ice cubes. You think the ice cube is going to melt faster than the long side does. So the melting ice cube traditional type of short selling has really been, it's almost completely disappeared since the global financial crisis. And the reason for that is we had so many years of emergency monetary policy where the short sellers were often correct overall in their thesis, but these theses took so much longer to play out because companies with access to extremely cheap money were just able to string out their demise. And they would borrow a bunch of money to make acquisitions that in actuality were making the companies weaker, but they were able to use those acquisitions for periods of years to create smoke screens that obscured just how badly the company's internal businesses had deteriorated. So that was the state of play going into COVID. COVID obviously was, if you thought that that monetary policy was loose prior to COVID, COVID was from another world, really, the response, I should say. So that made it extremely difficult. And you could say, well, what about post-2022 when interest rates rose? And I think the answer there, and I did think in 22 that maybe we were heading into a new market paradigm where traditional short selling might be able to stage a comeback. But there's still, even with rates having, being pretty close to their highs right now, there's still so much speculative liquidity in the markets. And the easiest way of benchmarking how much speculative liquidity there is just looking at crypto. These are assets that essentially have no worth, but they have tremendous value in terms of their market prices. So that tells you that there's still a lot of liquidity out there, regardless of whether we are or are not above R star. Now, activist short selling, subset of short selling, that's also become tougher over the years for some of the same reasons. Going into COVID, when I say going into COVID, I mean before COVID hit, we were out there pretty aggressively trying to raise money at the end of 2019 and early 2020, right before COVID became a thing. And what I was saying at the time is that all of this loose monetary policy had inured investors to risk. So the bar for us as activist short sellers, we're effectively in the bad news business. And so the bar for finding stories, for lack of a better way to put it, that investors would care about was raised every year just because people were inured to risk. And I do think the first Trump administration also had a little bit of an effect because there was just so much craziness every day, and everybody in media, and again, like I view activist short sellers as being a form of media, we're all competing to try to get our messages to break through. So that was getting harder. Then COVID, then the monetary response to COVID. And at the same time that you had all of this, well, it wasn't just monetary response in the US, you had fiscal stimulus as well, checks being sent out to people that often went directly into trading accounts. And that was also a function of the fact that, and this is something that I think is underappreciated, but when you're talking especially about the US markets, we had so many retail traders come into the US markets during COVID because sports were shut down. And so all these people who would punt on sports, the only sports on which they could gamble were Korean baseball. And so that kind of sucks. And so this punting stocks became the new form of entertainment that took the place or in lieu of sports gambling. And there are a lot of people who are still trading stocks. And and again, that's when you look at crypto, you look at some of the really speculative names. They've got real market cap. So that element is still present. So that those are some of the things that have made it tougher for activist short sellers. And then companies have become more litigious, more aggressive. Regulators, I think, have lost the page as well in terms of how they understand activist short sellers. Well, look, to be fair, I mean, not everybody in this industry is doing things the right way, but I think that's like every industry that's out there. We had a few insider trading cases some years ago in the US. Okay, but do you automatically assume that everybody who's doing long short equities is engaging in insider trading? No, you shouldn't. But with activist short selling, we have a problem where those of us who are doing things the right way end up kind of owning the sins of industry participants who are not doing things the right way. So I think that's also part of how regulators lost the page. So you have this confluence of factors. It's a tough job. And I think sometimes when you look on the other side and you're like, man, if I had just been long SPY for all these years, okay, I would have deferred taxes, compounded. Whereas, with short selling, I mean, you want to realize your gains as quickly as possible. That's the point. And that's, just when you think about the difficulty of this job, you're really sprinting on a treadmill if you're successful. Your ideas work out quickly, you have to go find the next one and redeploy capital. Whereas on the long side, I mean, if you're successful, you're just hanging back, you're not selling, you're letting that money grow, again, tax deferred until you eventually do sell. That's a beautiful thing. So I do think that it's for people like Nate Anderson, and I can't speak to why he left other than what he wrote on his website when he left. But I do think that there's an element of, we work really hard. I think those of us who are good at it, I think, are generally very bright. And we just look across the way and we see people who we think don't work hard, aren't bright, just making really good money in a really easy way. And I do feel like there's an element in our industry of feeling like our work is underappreciated in terms of the societal benefit or the benefit to the markets that it could provide.
It's interesting that you mentioned, SPY, the kind of S&P 500 ETF, and I suppose it seemed quite easy to be sort of long on that market, and well, for many years now, really, hasn't it? But how do you feel? I suppose recently I've noticed more of a chorus of kind of investors being concerned about, the concentration of returns in the S&P 500. Some concerns also about, I suppose, whether passive investing is distorting market dynamics, that kind of thing. Personally, I've always felt a bit skeptical of this, particularly when it's coming from, active managers who struggle to kind of outperform the market. But do you share such concerns? And equally, without asking you to predict the future, do you foresee anything that could kind of change the dynamic we've seen in recent years where, the the US market seems kind of unstoppable, that kind of thing?
So look, this is a major set of issues that you just hit
Mm,
on here, and there's not a concise answer, but I'll give you my view, and my view is largely informed. I want to give credit where credit's due. My view is largely informed by an investor named Michael Green, or Mike Green.
mm,
He's on Twitter at ProfPlum99. He's done a lot of research and writing about the effects of passive investing and how it's warped, in particular, the U.S. equity markets. And I fully buy into his conclusions. So here's you talk about the dispersion in the S&P, the difference in performance between the biggest names and everybody else. That is a byproduct of passive investing, and how passive investing has become such a it's really it's become the market for the largest market cap equities. So I used to think that, okay, well, passive investing will just have maybe a linear impact on the price of a given equity. That's not correct. These become, especially for the larger companies in the indices, these become parabolic impacts on prices, because this is Mike's analogy and the way he laid it out to me. When you look at the float of a company, that's the supply of stock. The float is no longer actually the float, because when passive owns a portion of the float, it will never sell until it gets outflows, right? Until it has investors net redeeming. So effectively, what happens is when passive buys from an active holder who is looking at the price and saying, yep, this is a good price at which to sell, I'm going to sell. When passive buys that, it's removing that supply of stock. So you have an ever decreasing supply of stock so long as passive is buying. Now, where it really starts to warp things and create this dispersion effect is that the S&P 500 index is market cap weighted. So at the same time, passive is going to shrink the supply of stock in Microsoft. And tomorrow, passive is going to come back and buy more Microsoft. There's less supply tomorrow than there is today, and there's still this bid that's willing to pay whatever the price is. It does not matter. So when you get this persistent bid every day and an ever shrinking supply of stock, that's when you get the exponential effects on stock prices for the larger companies in the index. Fundamentals matter on the margins. You'll see sometimes these things get whacked because of bad earnings print or bad guidance that's disappointing. But the largest names in the indices, they rebound, and they rebound for this reason. They're still really big, and a substantial portion of every dollar that goes into passive has to be allocated to that name, has to be allocated to Google. So why does this become a problem? Well, effectively, active managers are also being put out of business by this. So there will come a day when passive has net outflows. Now, the big passive buyers are what they call target date funds. In the US, these are retirement accounts, 401ks.
mm,
And if we have a situation where there are widespread layoffs, so fewer people are contributing to their 401ks, people are retiring, and people are also redeeming their 401ks early, even incurring tax penalties because they need the money to live off of. Well, if there are net outflows from passive has to sell. So who are the buyers? Okay, a lot of active managers have been put out of business. And so with passive being the bid and all of a sudden going on the offer and really having constrained the supply of stock, the way Mike puts it, and it maybe sounds too pithy, but I don't disagree with it. The way Mike put it is we'll have a 1929 magnitude crash at 2020 speed. So I do believe that passive's dominance and driving up the indices, but really by driving up a relatively small number of names here, is significantly increasing the fragility of capital markets. And it's not that, oh, well, if you own Microsoft, when this reverses, you'll get smoked. There are obviously going to be significant knock-on effects, that quickly spread to other equities because liquidity is going to recede, appetite for risk-taking is going to go away, credit markets are going to freeze again. And then the question becomes, can the central banks bail us out once again by causing us to take on even more debt in order to push up asset prices? So that's the really big nightmarish problem. Is that about to happen? No. For the moment, actually, at our firm, we've been working on a quantitative strategy, momentum-based strategy that we've started employing. We're actually going to be publishing a newsletter with some of the names in it that we're calling Lambos, which is an acronym for something like liquidity, something, something, something. But it's obviously, us kind of tipping our hat to that culture of who cares, close your eyes and buy. So yeah, I'm kind of going long, Lambos myself right now, just because I don't mean the Lamborghini car. I actually don't really like it, but this notion, because yeah, for the time being, I think it's going to work for a while. At some point it breaks, but might not even be in my lifetime. I have no idea.
So you've in that case probably already answered this question, but I did want to ask. Last year you were talking about how you wouldn't bet against Tesla, which is sound like a kind of Elon Musk specific thing, but more generally, I guess, going against, the US large caps, currently called the Mag 7, it has been very difficult for investors. What would it take for you to kind of bet against one of those, so-called tech majors?
Well, for us, I really don't see that, and not just because the passive dynamic, but look, there are people who've criticized NVIDIA's results. I've been aware of some engineering that Microsoft has done in the past of its results. That doesn't matter, right? These are very, very widely followed names. So with what we do as activist short sellers, we're looking for information asymmetries. So what can we find out that the market generally does not know? And because these are so widely followed, we're not going to find out anything that the market doesn't know that it would care about. That's the second leg of that. Like maybe I could find some reason to say, well, Microsoft's gross margin should be adjusted downward by 50 basis points. Who cares, right? Like that's, that. So it has to be something nobody else or is generally not understood and is going to be perceived as meaningful by investors.
That makes sense. And you've previously, this is a few years back, but you've made waves in the UK by betting against Burford Capital, which was a bit of a market darling at the time. Specifically in the UK, are there any kind of, I suppose, sectors where you're seeing sort of interesting opportunities, any trends you're keeping an eye on? Or is it simply that there's kind of more interesting things going on elsewhere?
Well, the UK could be of interest. We generally look askance at AIM listed companies that have market caps of a billion US or more, because kind of you start to ask yourself, well, why are you still on AIM with its reduced listing and disclosure requirements? But one of the things that has made Europe difficult for activist short sellers is the requirement to disclose your short position publicly when you're short at least 0.5% of the outstanding shares of the company. So that kind of creates a barrier, because with what we in Muddy Waters, we're generally focused on the mid cap space. Most short activists are focused on the micro cap and small cap spaces. So it's difficult for us to find, to be able to get a position that's large enough, given that we, Muddy Waters anyway, we manage, a couple hundred million effectively in short activist capital. It's difficult for us to put on a position that's meaningful enough that is going to be right at that disclosure threshold. Because if we're trying to get into the position and we're publicly disclosed as short, usually the stock reacts, and so at that point, it becomes, it's not really defensible to continue to size up if the stock has already reacted 15, 20, 30%. So that creates a bit of a conundrum. Now, the UK has decided to aggregate that reporting requirement, which was part of the EU's regulatory and legal framework. And I think not just from a selfish perspective of Muddy Waters Capital, but I think in general, that's a very healthy thing to do for the UK to get rid of that reporting requirement. So post-reporting requirement or post-aggregation of reporting requirement, there could be more to do there in the UK. But, I think the UK's markets are decent bit less dysfunctional than those of continental Europe. And, the conditions that make it difficult for short activists to operate, which have to do with the reporting requirements and also the hostility of continental European regulators, really the vindictiveness of them toward those who publicly criticize their companies. Those are the exact conditions that foster that dysfunction and create what should be, in theory, a target-rich environment.
Interesting. I don't know. I mean, this again is perhaps more in general activism rather than short selling, or it is. But I don't know if you've been watching. In the UK, we've seen Saba Capital having a bit of a battle with various investment trusts trying to kind of oust the boards and change direction. But it seems the industry has sort of, I suppose, closed ranks a bit and fought them off. I wondered if you had any view there on, kind of the state of things.
Look, I don't have views specific to what Saba Capital is doing, but one of the things I think in general about Europe, and in this case, the UK is part of it, is culturally very different from the United States in that all of these societies are post-aristocracy or post-aristocratic societies, right? Or they were, and there, I mean, you had kings, you had royalty, and people were rewarded based on where they started life, not where they got to. And I think that's always been one of the United States' strengths, is that we don't really have that legacy. And I do feel that tendency to really close ranks to protect the way things are done and the people I went to school with at Eton or wherever, I think that that's a vestige of aristocracy. Now, maybe I have no idea what the hell I'm talking about because I am an American and I haven't lived in Europe, but I do feel culturally that's one of the issues. It's what creates the opportunities for activism, but it's also what makes activism hard.
That makes sense. Let's turn then to other markets, and I suppose where you have been kind of focused. Last year, you launched a Vietnam fund. So it'd be interesting just to get your, I suppose, explore your kind of rationale there. Why does that market stand out versus, I suppose, other places you could launch funds focused on that kind of thing?
That was actually really a macro idea. So in April of 2020, when it was reported for the first time that the US State Department had previously sent cables expressing concern about the Wuhan Institute of Virology's handling procedures and safety, when I said to myself, on the back end of COVID, there's going to be a massive change in the way that countries do business with China. I previously had been a huge critic of China's government and of really a lot of our Western, a lot of our multinationals, the moral compromises and business compromises that they would make, knowing that their IP is going to get stolen, but basically saying, hey, by the time that's a problem, I'll have ridden off into the sunset, post, blah, blah, million in profits from my stock options. So I felt that politicians, have been co-opted and effectively bought off to not really change the relationship with China that much. But when I looked around in April of 2020, I said, well, whether it's the wet market or it's mishandling at the Wuhan Institute of Virology, I think the grassroots anger toward China is going to be such that our politicians cannot hold the dam, and that we are going to see the largest geopolitical realignment since World War II. And it's all going to be about countries' relationships with China. And I do think that the ensuing years have borne that out. I mean, Russia invading Ukraine is a byproduct of that. There are a number of big news stories that we're seeing that are byproducts of this realignment. But the question was, what's the trade? And the single largest beneficiary of this realignment in terms of, say, the redirection of FDI flows, single largest beneficiary relative to the size of its economy and its capital markets should be Vietnam. And and so and I know a little something about Vietnam, or I knew a little something about Vietnam already. The demographics are great. It's a population that's similar to the Chinese population, very eager to develop, learn, hardworking, and they were out, and in subsequent years have seen a lot of FDI that I think would have gone to China go into Vietnam. So the way that we approach Vietnam, even though we're dealing with public equities, we're backing what we feel are some of the best entrepreneurs in Vietnam. And it's also, to be fair, in that environment, it's one thing to have a great company, and a great company that's public, but it's also another thing to make sure that the controlling shareholders are not running the business solely to benefit themselves to the detriment of outside shareholders. Like, it is Vietnam, it is a developing market. We're well aware of that. We cut our teeth in China, being able to separate the wheat from the chaff and truth from non-truth. And so we're applying those skills to Vietnam. So very excited about Vietnam over the medium to long term.
And you're kind of a well-known critic of the Chinese markets. Would there ever be anything that could kind of change your mind on China being, I think you are among those who've used the term uninvestable, I think.
Yeah, no, I've been calling China uninvestable for, well over a decade. Yeah, you have to also understand why. So you have the fraud risk issues, which have never really been addressed. It's like Charlie Munger used to say, if you show me the incentives, I'll show you the outcome. With China, with overseas listed Chinese companies, it's, from a perspective of fiddling with the numbers, it's heads I win, tails I don't lose, because there's no ability to enforce against me. And P.S., the Chinese government has shown that it's fully protective of those who would defraud foreign investors. Then you also have significant manipulation of the Chinese markets, Hong Kong and also mainland China. And I think stocks listed in the U.S. that are based in, where the companies are based in China. I look at the way some of these things trade, and I believe there's significant manipulation of these stocks. And the thing is, the SEC will not be able to deal with this, because the SEC is staffed primarily, at least in enforcement, with attorneys. And what you really need now, this manipulation is likely algorithmic, and you need real data scientists. And real data scientists don't want to work with the attorneys who fill the ranks at the SEC. So that problem's not going away. So yeah, China's uninvestable for those reasons. Then there's the political capriciousness. And that is, you wake up one day and Xi Jinping has decided to shut down an entire industry or to shut down listings. And you could say, well, gee, won't Vietnam, Vietnam is governed by a communist party. Don't you have the same risks there? And my response is that I do not believe so, because China, and having lived there 6 years, it's maybe hard to explain the depth to which I perceive this, but there's just so much arrogance there, and so much, oh, you need us. We can do whatever we want. You need us. And there are very few countries in the world who can act that way. I mean, the United States does too, to be fair, but Vietnam is not that. Vietnam is, it's going to be an important country strategically for the US, especially for the West, but it's never going to have the mass that China has where it can throw its weight around. So I'm not concerned about that policy level, shafting of investors, writ large, the way that you have to be with China-based companies. So you have the fact that there's really no incentive for anyone in China who's got a publicly traded company to tell the truth with their filings, and since everybody they compete against for capital is probably lying, they're likely to lie too. Number one, and then number two, you have the policy risk.
Mm. Were you, on that note, were you not tempted then to launch an India fund? That tends to be the market most people get excited about as they're sort of, turning their backs on China and so on.
Yeah, well, interestingly enough, in a couple of weeks, I'm going to be in India. I'm also going to be in Vietnam. The same theme that has made us interested in Vietnam, and we opened our office in Vietnam to do research there over 3 years ago. So we have very deep understanding of the market by this point in time. But that same theme also does also hold true for India. And I think there's also a point here that countries that are non-aligned, we're now in a bipolar world. You've got the US/the West in one corner, and then you've got China and its allies in the other. And so countries that play the two sides off each other effectively, which I think Vietnam does and will do, and India does and will do, those are going to be the ones that, from a geopolitical perspective, are positioned best to benefit from trade flows. And India right now, it's interesting because there's a barrier to foreign institutional investment because the tax situation. So generally speaking, if I'm a foreign investor in a given market, my gains are not taxed locally. Right now with India, that's not the case. There are pretty high tax rates that can be applied to your gains. That's changing, at least in limited measure. So what I understand is 6 to 12 months, they'll probably have worked out the legislation. So that's probably a point at which a lot of foreign institutional money or non-Indian institutional money is going to start going to India. So India could be very interesting. Also quite dynamic like Vietnam, a lot bigger than Vietnam, but it's also a place of interest. Same theme.
Interesting. And finally, I just wanted to sort of return to something we touched on earlier, which is we spoke about the state of short selling, but obviously you do some, you go long and short. I suppose what are the kind of most interesting ways you find in which kind of short and long differ? And do you, I suppose, given the strains you mentioned at the start of our chat, do you think it's now just simpler to focus more on the long than the short, or what's the kind of mix there?
Well, they're in general not really mirror images of each other. Okay. So
Mm,
if you look at what the longs that we have in the US that are directional longs, again, it's a quant strategy that we're testing out. It's largely momentum based. One of the names that happens to be in the book at the moment is Palantir, which ripped yesterday. And that was kind of a joke inside the office, right? Like, oh, this feels great. We did no work on it and we're making money. There's this one charitable organization in the US called Robinhood. It's a Wall Street based philanthropy. And so every year they hold a stock picking contest. And yeah, you pick one long, you pick one short. And so I picked a good short, Grifols, which is a Spanish company, and so I'm short a crap co. But I picked a long called Oklo, small modular reactors. Sam Altman is an investor. It's just a great narrative. I mean, in reality, it's probably a crap co too. Like I'm long a crap co and I'm short a crap co, and I'm number 3 right now, ahead of Stan Druckenmiller. Who's that guy? I don't expect I don't expect to stay number three, but because like I said, I'm what I'm owning, what I'm long right now is narrative. So in the U.S., I think markets are so screwed up right now that on the long side, you're buying narrative. Okay, that's one of the things I do like about doing stuff in Vietnam, and we're also doing things in the mining space as well. We've got a
Mm,
resources fund that we just launched, which is principally long, focusing on junior miners. Um, a due diligence type of research approach there works. I mean, I want to be long Vietnam beta, so let me pull out the bad operators, and the guys who are problems. Let me look for the issues, and so let's be long Vietnam beta. That's different from how I think you'd make money in the U.S. right now being long stocks, which is what's got like what's got the really strong narrative, who's telling the story the best, what's getting people the most excited on social media. Go buy that. So I'm not proud of this state of affairs, but it is what it is.
yes, maybe easier to go with the flow to an extent. Well, I'm afraid that is all we have time for, but lots of interesting discussion. I'd just like to thank you, Carson, for coming on, taking the time. And thanks to everyone for listening. Take care.
Thanks, Dave.